Good morning, everyone, and welcome to this morning's session where we'll be sharing our 11s with Zehrid Osmani, who is manager of the Martin Currie Global Portfolio Trust. As leader of the global long-term unconstrained team at Martin Currie, he runs a portfolio with a concentrated approach and a high active share, which differentiates it from its peers and its benchmark. His forward-looking approach to analysis has led him to create a robust portfolio, which was partly insulated from the impacts of COVID-19, having very little exposure to the companies which were worst hit by the outbreak. The portfolio is also notable for the absence of big tech FANG stocks, and this also worked in its favour during the rough time growth stocks have had. I'm looking forward to hearing more about it, so without further ado, I'll hand you over to Zehrid.
Thank you, Pascal, and good morning, everyone. Thank you very much for joining the event. We have a few slides to highlight the characteristics of the trust. We're going to go into the market outlook and our thoughts around opportunities within that. And then we're going to go into the portfolio and the positioning. So next slide, Pascal, please. What we want to highlight here is for those of you who aren't familiar with the Martin Currie Global Portfolio Trust, we're highlighting the various aspects. The first one is that we have a high conviction approach. This is our investment philosophy. And we focus on quality growth companies, typically 25 to 40 stocks in the portfolio. Currently, we are at 29 companies with high concentration on very best ideas that come out of our research process. The top 10 holdings are 54% of the portfolio. And we look at capturing companies on the long-term time frame through fundamental analysis. So we focus on stock picking, selecting companies based on our fundamental proprietary research, where we look at various aspects around industry dynamics, around mega trends that companies bring us, and ensuring diversification. So the point about portfolio construction is important. Given our high concentration, we have an approach to assessing portfolio risk exposures that is proprietary, that permits us to achieve diversification even in such a highly concentrated portfolio. ESG is also at the heart of our process. We're looking for sustainable quality growth companies. We are highly rated by the PRI, and we have an embedded approach to ESG, which is part of our fundamental analysis with some proprietary ESG risk assessments, where we have 52 parameters as well as 20 parameters on social exploitation risk. The trust is truly global in terms of capturing the best opportunities. So it gives us that ability to find the very best ideas throughout the geographies. And we offer the benefits of an investment trust structure with a gearing that has been adopted by the board in Q4 of 2020. Low charges, no performance fee, quarterly dividends, and a zero discount policy, ensuring liquidity for our shareholders. On the next slide, we're going to look at market outlook and opportunities. So the slide after that, Pascal, we're highlighting 4 points. Firstly, there are a rising risk of a sharp economic slowdown, and we're going to go into that. Secondly, on inflation, we believe inflation remains frictional rather than structural, but it's certainly stronger and longer lasting, with potential risks related to monetary policy implications, with monetary policies normalizing more rapidly than the market expected. This has led to an increased volatility between value and growth, and we believe that will continue whilst monetary policies continue to adjust. In this environment, we're looking at earnings growth turning more negative, so earnings downgrades, notably brought by this downside revision risk from the Ukraine conflict, but also the China zero tolerance on COVID earlier this year, and now by the faster tightening in the monetary policies, which is also bringing a higher risk of hard landing. In this environment, valuation discipline is important, and we're going to touch on that in a moment. And finally, we continue to focus on companies that have the various following characteristics. We want structural growth or that long-term growth potential. We want resilient earnings, given the potential risk of downside in this macroeconomic environment. We want companies with strong pricing power, given the longer and stronger lasting inflation. And we want companies with solid balance sheets. If there's an increased risk of hard landing, solid balance sheets is an important criteria that we always apply to our selection. With that being said, turning to the next page on valuation, all we're going to focus here is on the bottom left-hand side. Our valuation methodology is based on long-term tools. It is consistent. It's aiming to put a fair value on a business, not what the market might be willing to pay over the next 12 months. As part of that, we have 50% of our price targets driven by discounted cash flows. All along in our discounted cash flows, we always used an assumption of a risk-free rate of 4%. So even when rates were at 0% or negative in some geographies, and certainly below 1% for the US, we used the assumption that that environment was abnormal, and we aim to anticipate normalization of monetary policies with a 4% assumption. And so when rates have been moving up over the past 12 months and have gone over 4%, that is the importance of using a high discount rate and an assumption of normalizing monetary policies. We can talk about this in more detail later on if there's questions, but that to us highlights that valuation discipline is critical at any stage in the cycle, but even more so when you have a period of abnormally low interest rates like we've had previously, because you want to anticipate those normalizations. And for us, that means that the businesses that we've been buying for our shareholders have been businesses that have shown upside potential to fair value based on that high hurdle of a 4% risk-free rate. In total, our cost of capital, therefore, is 8% when we look at any company. On the next slide, we're zooming in on the macroeconomic side. Leading indicators on the manufacturing side on the left and services on the right have been deteriorating quite rapidly across most geographies. You can see that for China, it's been a much more volatile pattern with lockdowns in Q1 that have led to a sharp collapse in manufacturing and services leading indicators, then a recovery as the economy reopened, and then again a rolling over. So for China, it's going to be a bit of an unpredictable pattern depending on the Chinese policies around lockdowns or reopening. China is the second largest economy in the world, so trying to predict a global economic cycle based on a very difficult to predict China momentum is really highlighting the challenge. But on the whole, our view is that we are heading into a sharp slowdown, given what the leading indicators are showing us at the moment. On the next slide, we're highlighting the importance of economic cycles. If you look since the start of the 70s to now, economic cycles have typically been 5 to 6 years. You have had a recession every 5 to 6 years. Our view is that there is a 70% probability of a sharp slowdown. This is our core scenario at the global level. We have increased our probability of stagflation from less than 5% at the start of the year to now 30% probability of stagflation over the next 12 to 18 months. The largest risk of stagflation is in Europe specifically, where for that region, we put a probability of 70% on that scenario of stagflation. Now, the importance of assessing companies through the cycle is that different type of companies and different types of style characteristics perform at different phases of the cycle. And you can see here we've got expansion, slowdown, contraction, recovery. If you look at the table at the bottom, in slowdown, value as a style doesn't perform any longer. Growth performs, quality performs even stronger, and momentum performs very strongly. And momentum is typically price momentum, but it's very correlated to earnings momentum, meaning that if one can find companies with earnings resilience, resisting the downgrades or seeing upgrades, the market will be favoring those, and that will show you that momentum. So for us, the importance as we're heading into a sharp slowdown is that quality growth companies should be favored. If you believe that contraction is where we're heading into, then value doesn't perform, but neither does growth. Quality performs and momentum continues to perform. Our view is that within the growth bucket is the unprofitable growth that you want to avoid in that phase of the cycle. Companies that are burning through cash, where balance sheets are deteriorating as a result. Our exposure to quality growth companies is mostly, over 99% of the portfolio is in profitable growth companies with high returns. And we're going to show you that later on. On the next slide, we're highlighting the importance of inflation, because inflation is what will be dictating monetary policies and monetary policy expectations. And our view about the quality growth part of the market is that once monetary policy expectations stabilize, we will be able to go back to fundamentals. And that's where the market and investors generally will be able to realize that some of these quality growth companies in which we're invested in are very attractively priced for the fundamentals that they offer. But on the left-hand side, you can see the rapid inflationary pressures across geographies and the correlation to the 10-year bond yields on the right-hand side, which have been moving rapidly. And that's what the market has had to digest, is this adjustment in monetary policy expectations towards a rapidly more hawkish bunch of central banks. We have a report out on inflation where we are actually highlighting that as you look at inflation, wage inflation, which is what we're highlighting on the next slide, is the most important factor to look at. Reason being is that wage inflation is the largest contributor to inflation by a long way. Typically, over 80% of inflationary pressures in the medium term get explained by wage inflation. So if you look on the right-hand side for Europe or the UK, or bottom left-hand side for Japan, wage inflation is not abnormally high at this stage of the cycle. So for these geographies, we believe that there isn't such a risk of persistent inflation, which is why our belief is that inflation is frictional rather than structural. However, top left-hand side for the US, wage inflation has been high and accelerating. For the US market, typically, there is a higher risk of that frictional inflation turning structural and therefore being more sticky. Our message, therefore, as we're watching inflation as a determinant of monetary policies and direction of such policies, is that all eyes should be on wage inflation as the biggest determinant in the medium term. On the next slide, we're highlighting that in an environment of a sharp slowdown or potential higher risk of stagflation, earnings downside risk is high. And you can see on the left-hand side that the earnings momentum has been deteriorating across geographies. We believe that that will continue to be the case. When we look at consensus at the global level, estimates are expecting 4 to 5% growth this year. We believe from our top-down assessment that growth this year should be closer to zero. For Europe, we believe that that growth should be at -5%. So still more downside risk to come. We've been predicting an increased risk of profit warnings since ahead of the Q2 results. That hasn't been as pronounced in Q2, but now is a Q3 result season that we're going through. You can see that there's a sharp increase in a number of companies that are warning and are disappointing, leading to sizable earnings downgrades. We believe this will continue to be the case over the next few quarters. Turning to valuation on the next slide, we have the PE ratio on the left, 12 months forward, and the Schiller PE on the right-hand side, which is the more relevant one. What you can see is that equity market valuations have come down quite significantly with this pullback since the back end of last year. But when you look at this 10-year cyclically adjusted valuations, the US market, whilst it has adjusted, still doesn't look as supportive valuation-wise as the European or the global, and therefore de facto the Asian equity markets. And when we look at opportunities from a bottom-up basis, fundamentally looking at stocks, we find more opportunities in European and Asian equity markets than in the US. And that explains our sizable underweight to the US equity geography to the tune of almost 20%, as we'll show you later on. The next slide, you can see the implied equity risk premium across the different geographies. Again, same message. European equity risk premium is more elevated than historically, and therefore that is where we see more valuation support. Turning to the risks for investors that we're highlighting 9 risks. These haven't changed actually since we wrote the outlook at the back end of last year. So on the next slide, Pascal, we're highlighting firstly policy mistakes around some of the fiscal initiatives. We've seen that in geographies like the UK, sadly, in the last months. But ultimately, it is important to focus on those because that can bring volatility. Equally, monetary policies mistakes could be another one, notably either the risk of not tightening fast enough or of over tightening that can bring a higher risk of recession. The stronger and more prolonged inflationary pressures is another risk because that will push monetary policies to be even more hawkish. The localized pandemic relapse risk, which is something we've been highlighting ever since the COVID crisis, clearly an important risk playing up for the Chinese economy this year, which will be very difficult to predict, therefore, that Chinese economic momentum. Style rotations continuing to remain omnipresent as monetary policy uncertainty feeds into bond yield volatility, which then feeds into that style volatility. Margin pressures from higher and longer lasting inflation for corporates is an important area of risk. Hence the importance of looking at companies with strong pricing power to protect their margins. And on the right-hand side, a few additional risks. Our view remains that in the long term, we're still facing a low long-term growth outlook. Tax rates are likely to be increasing, both corporate and household tax. Our forecasts actually assume a 300 basis points increase in corporate tax rates globally across geographies. So we want to anticipate this risk rather than wait for the announcements. And finally, sadly, a risk that has come into the forefront of investors' mind, the geopolitical tensions becoming more open. We've seen that with Russia's invasion of Ukraine, but also important to focus on the China, rest of the world, and China-US risk, notably the uncertainty around Taiwan. In that environment, we're looking at various opportunities in the midterm. We've highlighted 8. 4 of them on the left are focused on infrastructure spending. The first one is green and alternative energy, as countries are focusing more on decarbonizing. That has, of course, accelerated with Europe's drive towards more energy independence away from Russian gas. Energy efficient infrastructure, such as green buildings, another form of decarbonization. Electric transportation, both high-speed railways and electric vehicles. And healthcare infrastructure, given the need to upgrade the healthcare infrastructure post the pandemic crisis globally. And on the right, a few additional themes that we've highlighted before, but that have been accelerating. Firstly, the 5G telephony, given the upgrade cycle in that sector and the need for countries to become more competitive on communication. Cloud computing, because more companies have migrated their presence online. As a result, also the need for more cybersecurity. Robotics and automation, because more corporates are focusing on making their production bases more resilient and their supply chains more robust. Therefore, an increased investment in robotics and automation is highly likely. And finally, nascent themes, but fast growing, and where there's a considerable amount of investment spent by some of the big tech companies, metaverse and quantum computing. With that said, we're going to turn on to the portfolio. First slide is the performance. The point to highlight here is that in an environment where the market has been shifting the style leadership away from quality growth towards value, our performance has been challenged given our focus on quality growth companies. Notably, as some of our shareholders know, we have no energy exposure, and that has hurt us during that energy price flare up in the first half of the year. We have no exposure to banks, and banks have been performing well in a more favorable interest rate environment. But our focus remains on companies with quality growth exposure. And what we've been doing is ensuring we continue to stress test the conviction on each of the stocks in the portfolio, ensuring that we deliver the best ideas for our shareholders. On the next slide, you can see our top 10, and you can see that some of them are suitably sized for the conviction that we have. There are companies that have exposure to different type of sectors: healthcare, technology, materials, consumer, and industrials. So good diversification sectorally. But when we look at some of the characteristics of the companies, they all have a similar set of characteristics. They have high barriers to entry. They have dominant market positions, or the potential to be dominant. It gives them strong pricing power, and that's important in this environment. They typically have low disruption risk. They are facing structural growth prospects. They generate high returns on invested capital. They have solid balance sheets and strong cash flows. And when we look at the ESG lens, they have good corporate cultures, quality management, and sustainable business models. But at the heart of that whole assessment, when we look at valuations, they have attractive valuations given the fundamentals that they're offering to our shareholders. And we'll go through that in a moment. But before we do that, quick update on some of the transactions in the last 12 months. We sold out of Alibaba last year. We sold out of rumpjd.com on the next slide, Pascal, in Q1 of this year. And the biggest transaction that we did current of the year has been switching out of TSMC into SML. We kept the exposure to the semiconductor sector, but moved further upstream in a company that is in a stronger position as leader, almost quasi-monopolistic characteristics, and therefore stronger pricing power. Company that has higher returns on invested capital compared to TSMC, and that gives us the ability to capture some of the dynamics around the geopolitical risks around Taiwan, specifically with TSMC building plants in the US, in Japan, and we think at some point in Europe. ASML will have the opportunity to ship its tools not only to Taiwan, but also to the US, Japan, and in due course, Europe, which will create a better opportunity for sales and through scale economies, better upside on profits, which we believe the market isn't capturing properly. On the next slide, we highlight the fundamentals of the portfolio, and that's where we're very excited. Might be somewhat technical, but bear with us. On the left-hand side, you can see what the portfolio looks like. Net debt to EBITDA, i.e. balance sheet assessment, very strong. Very under-geared companies, which is important if we're heading into a recession. Then when we're looking at the growth profile of each company, we like the growth to come from revenues, not just profits. And we're forecasting a revenue growth of 13% annualized for the portfolio over the next 5 years, compared to an index delivering 6% growth annualized over 3 years. And that superior growth on revenues, at least twice the rate of growth on revenues, keeps delivering on EBIT, earnings, dividend, and cash flow. If you're focusing on the earnings for a moment, we're forecasting 13% annualized growth for the companies we're holding over the next 5 years. But the index consensus is looking at 8%, but we believe that number is too high. Numbers are coming down. We believe this year it's going to be 0% growth. Next year could be another year of no growth or potential downside risk to that assumption. So if you're taking that into consideration, we're looking at an index growth of closer to 4% annualized. So the portfolio delivers 3 times the rate of growth of the index. Then when you look on the right-hand side, not only is the portfolio offering superior growth, but it's also offering higher value creation through superior return on invested capital. On average, the trust has a 32% return on invested capital compared to the index at 8.2%. This is the last historic figures. We project that 32% to go to 39.1% by year 5 of our estimates. We don't have a number for consensus, unfortunately, for the index, but it highlights that the portfolio offers high growth on revenue, profits, cash flows, high returns with rapidly improving returns, which makes us confident that no matter what market environment, on a rolling 5-year basis, these companies, if our assessments are correct, should deliver strong returns to our shareholders. On the next slide, we highlight a few aspects. One, the exposure on the bottom on country weights, big underweight to the US, overweight to European and some of the Asian countries, as you can see. Top left-hand side, you can see that there are sectors we don't have exposure, such as energy in particular, but also utilities, real estate. Big underweight to financials, no exposure to banks. So those sectors specifically have provided us with some headwinds given their performance. Our focus remains on a balance of exposure between technology, healthcare, consumer, and industrials, where we see the most attractive opportunities and the most opportunities for finding companies that can create value for shareholders. We still don't have any of the FANGs, which is an important aspect to mention as part of our underweight to the US. And the reason for that is fundamentally driven. Various companies within those FANGs are, in our view, challenged, either in terms of growth assumptions or in terms of diminishing returns on invested capital, or they have higher regulatory risk for some of them. And we'll finish with the earnings resilience of the portfolio, and we'll open up to questions. What we're highlighting here is sales revision, which is the first 2 buckets on the left, and earnings revision, the 2 buckets on the right. This is for FY1, so this year, and FY2 next year. And what you can see in red is that the market, as we saw from the chart, is seeing downgrades, both at the sales and at the earnings level. The portfolio has been able to show resilience with sales revisions actually up. If you focus over the last 6 months, you almost have 2% of upward sales revision on FY1, about 1% on FY2, in a market that is seeing 2 to 3% down revisions to sales. On the earnings revisions, you can see that this picture is similar. Even if the portfolio is seeing some downwards revision, it is being more resilient, notably on the 12 months picture. But you can see 12 months or 6 months, the portfolio is seeing less down revisions than the market. And that's really what we highlight in terms of focusing on companies that will give us that resilience. Yes, we do have some companies with cyclical exposures because we look through the cycle. We have a mixture of companies that are defensive and cyclical, but the ones that are cyclical, we believe will be able to withstand a recessionary environment, will be able to more than cover the cost of capital, as they have done in the worst of the financial crisis of 2008-09, and will be able to resist some of the downgrades, even if they won't be immune to it. And with that being said, we'll leave it there, Pascal, and open up to questions.
Hi, Zehrid. So we've got a bunch of questions here, which I will start at the top of. So starting with some questions about the stocks and your kind of approach to those stocks. With the kind of decline and the big sell-off of the FANGs, are you starting to see any temptation to get involved in them? So things like Meta and Amazon, Alphabet, have obviously been hit very hard. At what point do you start thinking they're a good value?
Yeah, it's a good question. So we always will have an overlay of valuation, and that's indeed the important aspect to mention. In the case of the various FANGs, so there are fundamental reasons why we don't like those businesses. In the case of Meta, we believe they're increasingly challenged to grow their user base. They have some element of challenge in terms of generating trust with their customers, given their approach to data usage and protection. So this is a company that we believe is challenged structurally. They are spending a lot onto the next opportunity of metaverse. But our approach to this is, whilst we see that there might be a potential opportunity, we prefer to harness that opportunity through the enablers of the metaverse and really capturing where Meta is spending the money and capturing those picks and shovels effectively. So looking at companies in the semiconductor space where we're still positive in the long term, or companies like NVIDIA that provides superior graphics cards and therefore is able to capture what is needed in terms of making the metaverse a reality, which is superior graphics as you use some of these virtual reality headsets. In the case of companies like Netflix, we've always taken the view that there's an important pressure competitively in terms of race for content. And with the race for content from the likes of Amazon Prime Video, Apple TV, Sky, Disney, Netflix will also be challenged. There'll be a price inflation on content, and that will lead to diminishing return on invested capital. In the case of Google, we have concerns about the regulatory scrutiny, the threat to their business model and the pricing model. And in the case of Apple has actually been a very strong performer, and we've missed that stock. The concerns we've had with Apple is the technological advances of some of their competitors, and therefore the stronger competition from the likes of Samsung. But clearly they've been able to navigate through that. Ultimately, we have preferred Microsoft, which for us has been the name that had more valuation support and generating high return on invested capital. And the last one is Amazon. This is a name where, again, when we look at some of the growth profile, we're not as attracted to that name as some other names in the portfolio. So whilst this is a name that has potential for us, we believe that at this stage, the attraction is not high enough for us to be involved.
Thank you. Looking at the dollar exposure in the portfolio and the US exposure, if we would see a reversal in dollar strength and the flight to safety, would this have an impact on corporate earnings for your biggest holdings?
Yes, it's a good question. Indeed, the strength of the dollar has been such that it's been going to fall. Some of the US companies have clearly had wins in terms of reported area. In opposite, some European and non-US companies have had tailwinds, and that's softened some of the potential risk of earnings downgrade. So the question is well put. We always look at companies in terms of FX exposure. And when we assess companies, we assess whether they're naturally hedged, so whether the FX exposure is purely translational, or whether there's some transactional mismatch that can create higher pressure on margins if your cost base is in dollars and your revenues are more global, or vice versa. So this is an important area of focus and is constituting part of our analysis. Performance-wise, being underweight the US equity market to the extent that we are, given the dollar strength, which has amplified some of that underperformance for us from that FX element. But something we continue to look at, continue to capture in our assumptions, and ultimately look at companies that can be well positioned and navigating through some of that volatility.
Questions just come in which follows on quite nicely to that, which is, has the rapid strengthening of geopolitical threats and uncertainties in the world affected your risk assessment and the kind of process around that?
It's a very good question. Geopolitical risk is always something that the market focuses on. At times, tends to over-amplify the actual implications for fundamentals. We think in this instance, because the question is probably targeting China and Taiwan, this is a very difficult risk to assess. It is clear that China is making some very clear statements around reunification with the Taiwanese territory. It's also very clear that the US is making big statements about their intention to protect any aggressive approach by China around that territory. We have taken the steps to reduce our exposure to that geopolitical risk through the switch out of TSMC into ASML. And as we are highlighted earlier, ASML is to some extent benefiting from the implications of that geopolitical risk, which is production site proliferation across geographies such as the US, Japan, or Europe, which it will be able to benefit from. So to some extent, we have taken action to reduce that, whilst being mindful that that risk is very difficult to predict or indeed quantify.
Great. And another one that's come in sort of following on to the same theme, not China, but kind of, global kind of thematic weather. Your consumer discretionary holdings are predominantly in developed Europe. Given your comments in the presentation about the economic situation in Europe, why are you slightly overweight consumer discretionary, and particularly in Europe?
Yeah, it's a good question. So when we look at our consumer stocks, whilst many of them are quoted in Europe, they're actually exposed to the global cycle. Notably, the luxury goods like Kering or Moncler, quoted in France and Italy, respectively, but have exposure globally. To us, the aspect to highlight here, and specifically on luxury goods, the relevance of China, because typically in luxury good consumption, the Chinese consumer is about half of that consumption. And it has been challenged by the lockdowns. And these companies, despite that, have actually been able to post good operational momentum, despite that largest market, the Chinese consumer market, being in effect impacted. We don't have any visibility on what will happen to China in terms of further lockdowns or reopening. There are periodically excitements about potential for reopening. Our assumptions assume that China just muddles through and there is no change to the COVID policy. But we think that these brands will be able to navigate through that despite that. It gives us optionality. If China reopens, these companies are going to be really well positioned. This is a sector where there is pricing discipline. And the final aspect, and at the heart of that question on consumer, is that this cost of living crisis has to be analyzed on the stock specific basis. And what we mean is that cost of living crisis tends to impact mass market consumption more so than high-end consumption. Yes, high-end consumption can be cyclical, but to some extent, it is in this environment, given the type of crisis we're facing, going to be less sensitive than your mass market consumption, where households feel the impact of rising utilities bills and energy bills will be clamping down on that everyday consumption. So we're actually more cautious on the mass market consumer, but more supportive of the high end with that optionality of China reopening, with that long-term structural drivers of middle class development in emerging markets. So we're staying exposed to some of these names.
Mm-hmm. The same sort of person has asked, just as a follow-on, could you answer the same question, but with European conflict as a potential thing that might happen in mind, and also potentially post-election in the US, a different kind of outlook from that side of it, from America? Yeah.
So if it's specific to the consumer, perhaps the question on the European conflict relates to potential energy disruptions and energy rationing that could impact some of these companies' production bases, notably for luxury goods that produce in Europe. So our view is that at the moment, with European countries having managed to rebuild gas reserves ahead of the winter, we should be able to not have those risks of rationing into this winter. And the risk will really be what will be the situation in the run-up to winter 2023. By then, clearly, these countries are taking additional action to further shift away their dependence away from Russian gas and find alternatives. So this is a situation we'll be assessing. At the moment, we think that the nearer term risk isn't there. We think that the European conflict clearly is leading to the equity risk premium being elevated, as we saw in the slide. And perhaps, Pascal, you can go back to that slide, which was on page 12. And there lies the opportunity really around that aspect, is that if there was some hopes of resolution to that conflict, clearly there would be more upside potential for European equities. The question on the US, clearly that the US midterm elections, clearly that is a potential risk for the Biden administration. Biden administration that has been very active at trying to put through various policy initiatives ahead of the midterm election, given that there is a risk if the Republicans win that midterm election, that any policy initiatives coming through after that will be greatly impacted.
Thank you.
Again, an important aspect of. Sorry, Pascal.
Sorry, yeah. There's just a couple more questions here. Two different people, but both on the same theme about Japan. Obviously, the portfolio has no exposure to Japan. The first person is asking why not, and the second person is asking even more forcefully why not, given that the yen has been destroyed and Japan is on a valuation basis potentially cheap. What's the answer there?
Yeah, it's a good question. So when we look at opportunities, we look across the globe and we look on a bottom-up basis. We've struggled to find good opportunities well priced in Japanese equities, or we find better alternatives across different geographies outside of Japan. And where there have been some good opportunities in terms of companies with high growth and high returns and well exposed to the global cycle, we have struggled to engage with these companies in the Japanese market. And our approach is always that we need to have engaged with senior management of a company before we decide whether a company is investable or not.
Thanks. Couple here about China, and we've talked about China already, but particularly about how has the zero COVID policy and its continued persistence and at no less height than it has been, how is that not affecting your view of China's future? Do you think they can continue with this policy for long? And what happens if they do, from your point of view?
Our view is that our default assumption is that China will continue with a zero tolerance on COVID. There is no reason why they would deviate from that, given that they've made that policy an important focal point for President Xi Jinping and an important difference to how China has handled the crisis, the pandemic crisis, compared to the rest of the world. China is also having various challenges, such as its healthcare infrastructure is still not able to cope if there was a major outbreak, and their vaccination policies have not been as active and as efficacious, given the vaccine that they've used, as some of the countries in the West. And therefore, there is still a risk for them from reopening, and that's why our assumption is they're going to carry on with being very stringent and closing down regions when there's an outbreak. As a result, our forecast for companies that are particularly exposed to China, such as the luxury goods companies, but also some of the industrial companies, is based on that assumption that there's not going to be a recovery, a sharp recovery. So growth-wise, China could remain challenged for the next couple of years. But by capturing that assumption and feeding that into our valuation assessment, we still see decent upside to some of these valuations. And we don't see any much away from some of these companies, given that that risk is already well captured in the market.
Got it. I think we've got time for one more. This is again on China, and it's how, given the portfolio's kind of status from an ESG point of view and the sort of credit it's won for its ESG process, how do you kind of manage to invest in China and square that away with strong ESG, given China's kind of increased the focus on ESG in China and then the lack thereof, And also, do you think there will be, a stronger backlash going forward against China and against the things that it does, which are not what we would describe as ESG? And how does that affect your exposure there?
It's a very good question, and it gives us the opportunity, mindful of time, to highlight that the trust has 5 Morningstar glows for sustainability, which really captures that focus we have. And so with that in mind, our exposure directly to China is through a couple of stocks: WuXi Biologics, which is actually globally exposed in the healthcare space, and AIA in the insurance space. And these companies have very good ESG assessments based on our proprietary assessment, both on the governance side, but also on the E&S. We actually find when we're looking at some companies that despite what might be the perception, there are some companies in China that are scoring very highly on various metrics of ESG. So we really take it on a case-by-case basis. Yes, where we're not comfortable with the governance structure or the environmental and social risks that a company bring, whether it's in China or across other geographies, we will not invest. But equally, we'll take it on a case-by-case basis. And some Chinese corporates are very keen to catch up with ESG standards of the West, or actually at times drive best in class.
Brilliant. Thank you. I'm afraid that's all the time we've got for questions today. So thank you, Zehrid, for joining us. We've got 4 more events next week, which if you in the audience would like to join us, we'd love to see you there. There's some information about them in the events section on our website, and you can register for them any time up until they start. But if you've got any problems, just drop me an email or get in touch with someone at KTI. In the meantime, once again, Zehrid, thank you very much for joining us and all the fascinating stuff you've shared with us. And thank you all for staying with us to the end.
Thank you, Pascal, and thank you everybody for your questions and your interest. Have a good day.
Have a good day. Bye.